Welcome to My Talk, the podcast series brought to you by ISS Market Intelligence. If you're interested in what is happening in the global financial services marketplace, be it asset, wealth management, life insurance, fintech, you have come to the right place. Count on My Talk each month to keep you appraised of developments in the business and also peek under the hood of the industry headlines with the help of some industry experts. And also a reminder, if you enjoyed this episode of My Talk, please subscribe to our podcast on your preferred podcast platform. There will be monthly episodes, and in some months we do more than one, and they will always feature thought leaders in the world of asset and wealth management, life insurance, and banking. My name is Goshka Folda. I'm your host and Global Head of Research at ISS Market Intelligence. Today's episode will continue our recent exploration of topics in the intermediated advice arena in the US, but this time we will shift our focus to a life insurance wealth product, annuities. And to help me flesh out this topic, I'm joined by our internal expert, a well-known figure in the life insurance business in the US, Mark Jeffries. Mark is an associate principal at ISS Market Intelligence, a member of the product engagement specialist team, where he works with Ashley Wood, who was a guest host on our firm's insurance and annuity client relationships. And Mark has the privilege of working with a lot of leaders in the life insurance business in the US and is absolutely chock full of color and knowledge about arena. And today's focus will be annuities. Welcome, Mark.
Thank you, Goshka. Pleasure to be here.
Thank you. So, Mark, let's start maybe with kind of a bit of a classic question whenever I like to talk about the life insurance industry. What are some of the current economic environment factors that are that kind of macroeconomic and rising interest rate backdrop is translating in terms of implications for annuities?
Yeah, I think at a high level, really the macroeconomic factors had led to an explosion in the sales of annuities, where 2022 is on pace to have a banner, if not record year. And I think the demand for annuities increases when consumers perceive higher risks related to the economy and perhaps an imminent or looming recession and seek portfolio protection. So what does that mean from an annuity product point of view? We've seen that the gains in annuity sales have primarily been driven by the sales of fixed rate and fixed index products, while VA products have experienced some pretty considerable declines relative to the past few years. And just to further expand on that, so fixed index and fixed rate sales, rising interest rates and increased market volatility, investors are seeking protected growth options, looking for principal protection with limited growth potential. And when Federal Reserve rates increase, insurance companies can typically earn more. And when Federal Reserve rates increase, insurance companies can typically earn more in bond yields, which allows them to offer higher rates to their customers, which in turn has made those fixed rate and fixed index annuities more attractive when thinking about what type of other sold against bank CDs in particular. The current rates on those fixed products are 3 to 4 times what you could garner by going into a bank and purchasing a CD. And it's no surprise that the vast majority of fixed rate annuity sales are being driven through the bank broker-dealer channel.
It's really, I think, a reaffirmation of perhaps something that we have seen in the business throughout the past 30 plus years that I have been observing it in the fact that both annuities and more broadly risk management or principle are typically counter-cyclical play to both the macroeconomic environment and the market volatility. So I think that's a really good point, that there is definitely a greater interest both on the part of the investors and advisors for sure. And we're seeing this on both sides of the border actually. And you mentioned rising interest rates, but from that perspective, so it seems like the demand is well articulated. Annuities, particularly of the fixed kind, are doing very well. The business volumes are steer. But what are some of the challenges for carriers as they offer or as they emerge from the COVID years and really try to capture that emerging opportunity?
Yeah, I would say from I think sticking to the product theme for the moment here is that some of the annuity products that have driven the market over the past few years, i.e., the variable annuity family of products, has come under great duress and headwinds, just given the macro that are tied to equities. They have sub accounts. They are more risky, and as a result, consumers are less apt to put their client dollars or their dollars into those traditional VAs. Another product that has been really the darling of the VA or annuity industry over the past few years, registered index-linked annuities. Those sales have they've remained strong, but they've been tempered over the past few quarters relative to the explosive growth that was achieved in 2020 and 2021. As one of the core benefits of the registered index-linked annuities is that there is a buffer or floor on the products, meaning you can only lose up to the downside protection is up to a minimum percentage, and then after that, the consumer is on the hook. Is up to a minimum percentage, and then after that, the consumer is on the hook. And we've really never seen this degree of a market downturn to test the buffers and floors in place, right? And speaking to RILA, there's been a proliferation of RILA products that have essentially saturated the market over the past 2 years, and they are also now competing with fixed index products, which now all of a sudden have more attractive rates associated with them, and they also have zero downside. They have full downside protection while still being able to catch. I think the traditional VA product line is certainly strained at the moment. RILA sales, while doing well and chugging along, have been tempered versus what we've seen in 2020 and 2021. And I think just the overall increased competition, particularly on the fixed rate and FIA side, rate-driven environment, and carriers are really having to be aware of that rate game and position themselves.
Yes, and I think that you mentioned, I think in passing here, the proliferation of products and really the competition on the advisor shelf, which is again almost reverberating the theme that we discussed with Ashley and Jeff Duckworth last month about that kind of you have to bring your A game to compete and stand out on the shelf. So what are some kind of evolving themes in terms of advisors, their preferences, and how can carriers really break through, if you will, through that busy and crowded shelf?
Yeah, absolutely. So the shelf and more carriers similarly designed rates, are generally in the ballpark, so to speak. Obviously, each carrier has a different strategy in place, but by and large, their rate is a big criteria with which advisors use to differentiate. But I think really from also an annuity carrier point of view, it's the overall advisor engagement. And as Ashley and you and Jeff were discussing last week, the advisor behavior post COVID, or as we emerge from the pandemic, has changed. And it's almost as if you need to approach each pattern. So number of days that advisors are spending in the office. Do they prefer to meet in person? Perhaps Zoom, perhaps a combination of in person or virtual. And in fact, Market Metrics, ISS MI runs an annual annuity sales force study, and I've actually pulled a couple quotes from wholesalers that I think are pretty telling to the current challenges that external sales teams are facing in the industry. And just to quote a couple of folks here, the whole landscape has changed. Advisors aren't in the office as much, yet they don't want to meet over Zoom typically. So I'm able to have dwindled because it has to be a meal or happy hour or something extra to get them out. And at the same time, many carriers are also grappling with what the appropriate team and budgets should look like to foster appropriate engagement. So a couple of key themes is that pandemic has altered the tradition of honoring wholesaler FA engagement on a daily basis. FAs are more comfortable than ever to dismiss the meetings or even not show up at all. Basically just the access to advisors and their overall preferences have changed, and it's more difficult to get those meetings scheduled, whether they be in person, face to face, or via some virtual means.
So I find that to be probably really fascinating from the perspective of any life insurance product, including annuities and or ILAs. These are more complex products to explain, and one would imagine that while I think being detached from advisors face to face in a traditional mutual fund 40 Act fund might be certainly is not ideal, but can be that have kind of tweaks of features and important aspects to them that need to really sometimes be considered and debated and discussed. I think that's probably a pretty big development that you're seeing from kind of advisor and engagement perspective for annuities providers.
Yeah, absolutely. They are not the most simplistic products, if you will. So it is very important for those wholesalers to get in front of advisors to articulate the value and perhaps how their product differs from some of their competitors and how that product could meet the specific needs of an advisor's clients. And that's becoming more difficult to do, right? And it's about finding that appropriate balance, or really on a case-by-case basis, those folks in the field getting a better understanding of the preferences of the offices in their territories, so to speak, so that they can most effectively engage and get their product messaging across.
Yeah, and again, a bit of a paradox, right? Because the demand is there, and and I think the carriers are ready to jump into the fray, but advisors are saying, okay, you'll have to fit into our life game plan or work life game plan, and it's really an evolving topic. And I know that you repeat this study, so it'll be really interesting to see next year's results. Kind of the uniqueness of the products. And sorry if I'm jumping ahead, but there was a question that really popped at me. What's happening to the VAs with the guaranteed life benefit component? Because again, VAs, any market sensitive strategy or product is right now punished, understandably so. But when you think about the mass of current and future retirees that are coming into the focus of their retirement in the next year, 2 years, 5 years, you would think that these are products that still would be incredibly compelling. What's happening with that subcategory?
Yeah, so and I believe what you're referring to are those traditional variable annuities with those lifetime income riders associated with them, and I believe what you're referring to are those traditional variable annuities with those lifetime income riders associated with them, and I think what we've seen, and this has probably been a trend that's been emerging for 18 to 24 months at this point, but even with recent rising interest rates, which generally prop up bonds and other fixed income assets that are used to support guarantees, we've seen that the industry overall remains on a path to de-risking, meaning that carriers are pivoting away from or making pivots to less interest rate sensitive and more capitalized products, basically with low guarantees, right? The risk is not as much associated with their balance sheet. And I think the best example of this is carriers pivoting away from VAs with lifetime income guarantees to registered index-linked annuities. And going along with that, traditional VAs, I mean, there are less carriers that are offering those types of products. The economic environment doesn't necessarily favor those. And also another trend that we see is just a movement towards lower fee-based or lower fee structured products, which those traditional VAs certainly are not. So that's why we've seen the emergence of that RILA segment where you can experience market gains and have some level of downside protection with a lower fee type of construct.
Yeah, Mark, I think that's really interesting. And that theme of really trying to manage the balance sheet of the carrier is one that is absolutely a global theme. And we have seen the factor withdrawal in some jurisdictions, including a huge reduction of these guaranteed lifetime income riders in jurisdictions like in Canada, which where the carriers are moving in a regime which is even you could argue a little bit more punitive in terms of market a lot of these long-term liabilities. But that's a topic for another session. We're going to have one on life insurance, and I'll then dig into that. I do want to talk a little bit about some specific advisor needs and preferences. You shared with me some ideas about kind of critical drivers of satisfaction for the various types of producers. Could you maybe talk a little bit about what you found through the study about that topic?
Yeah, we conduct interviews with annuity producers, and we then are able to run some analysis to determine what are the most important elements that they are evaluating carriers on, and what are the levers that carriers can pull to better position themselves to win business. And a couple of those, what we deem to be critical drivers that emerge are, first and foremost, and going back to one of the previous topics here, is field sales support. So to reiterate, understanding the specific preferences of advisors and creating meaningful touch points, whether that be in person or via virtual meetings. We're not ever going back to the wholesaler function of all in-person meetings. So it's critically important to effectively understand preferences and make those touch points meaningful. So certainly field sales support. The product itself can, it will continue and always will be a critical driver. And just to go through those, product categories, fixed via, it is more of a commoditized type of product where it's primarily rate driven. Thinking about registered index linked annuities, attractiveness of the rates, certainly low expense structure, having a suitable buffer and floor, features such as performance locks. From a traditional VA point of view, as I noted, there's been a movement away from those types of products. And one of the drivers is that consumers or clients are looking for lower fee type of products. So traditional VA point of view, low base contract fees, attractiveness of that income rider, which we touched upon, open architecture to be able to select the type of sub-accounts and investments that your dollars are going to be placed into. And then I think from an overarching point of view, just the simplicity of product design. There's been a growing complexity of products, and it's becoming more and more difficult for the advisor to go to their client to articulate the value in a coherent manner, right? So just the simplicity of product is certainly paramount. And then from an operational support and problem resolution point of view, and this is really the advisor and their experience in doing business with carriers. From the new business processing, so we think about the application, suitability review, policy issuance, and right on down to in-force servicing and telephone support. So these back office functions and service desks have been under some strain due to booming business and also some of the labor shortages that have surfaced. So for carriers to be able to execute from a new business and operational point of view is certainly will move the needle, and then that those advisors want the business to be as seamless and straightforward as possible. And I think lastly, touching more of a macro level here, is just the financial strength and reputation of those annuity carriers, right? They are balancing their balancing balance sheets, balancing balance sheets. They are having to fund all of these products. There's considerations such as the company standing. Is it a mutual company? Is it publicly traded? Is it private equity backed? What is their S&P or AM Best credit ratings? So those all come into consideration. Business, reinsured, etc. So the overall financial strength and reputation is also one of those key criteria with which the advisors are evaluating carriers on.
Yeah, that's really great points, Mark. And if I can summarize on the product, I love what you talked about. So low fee, flexibility as in open architecture and access to different investment strategies, and simplicity. These should be the mantra of any product development a developer, both in the life insurance and in the investment world as well. So we are kind of running close to the end of our chat, but I wanted to maybe for you to highlight a few key trends that you see in the annuity market as we look ahead to 2023.
Yeah, absolutely. And I think some of these themes are a bit overlapping of what we've already touched upon. But I think from a product point of view, we'll continue to see fixed rate and fixed index products be quote unquote the hot items into 2023, given market uncertainty and the continued high interest rates, which are active to consumers. I think from a traditional VA point of view, hopefully those rebound, but they are at the beholden to the economic environment as well. And if we see a rebounding in the equity markets, consumers will be more comfortable in putting their dollars into those trades that are more susceptible and have limited market protection. I think another key trend is, which we really didn't touch on, is the growth of the fee-based or advisory industry, and that continues to be talked about as the next big thing. But as it stands, according to our data, and of the 5% of fee-based or advisory annuities sold, 40% are through RIAs. So that is continuing to be a growth opportunity, but we haven't really seen that explode to date. And then in closing here, just to talk about from a sales and distribution point of view, I think we'll continue to see the evolution of sales teams from both a staffing allocation and structure vantage point. We've seen a number of carriers restructure, dechannelize, meaning that their wholesalers are calling on channels across the wires, regional, bank, and independents, perhaps updating their territory construction, thinking about hybrid deployment, given that at one point during the height of the pandemic, everyone was quote unquote hybrid. And then lastly, just continuing to see carriers become more data savvy, leverage a lot of, frankly, the work that ISS Market Intelligence does to become more savvy in an effort to make wholesaling more efficient. So at a high level, a lot of things to look forward to in 2023 and see how the market evolves. But I think it's been a really strong year from an annuity point of view, and I think a lot of exciting things to come.
Well, thank you, Mark. This has been just most illuminating and a fascinating topic. I'll have to tell you that I originally started observe variable annuities in Canada when it was just taking off in '95 as a young analyst. So they do hold a special place in my heart. So thank you so much, and I love the point that you just landed about the fact that given the competitive landscape, proliferation of product and providers, and the somewhat tricky advisor engagement, having data-driven, strong, powerful distribution strategy is probably the best route to success and to securing growth in this segment. Thank you so much, Mark, for today's discussion. And that is a wrap for us this month, and it is a wrap for this year. In the new year, we will be returning with an episode focused on Canadian investment fund and deposit flows, a hot topic. Also in this rising interest rate, and potentially recessionary environment, and with market volatility accompanying us almost on a daily basis. We will also be returning with Mark and a discussion of life insurance in the US. But I wanted to thank all of my guests for this year for their contributions. And most of all, I would like to thank all of you listeners for embarking on this podcast journey with us and so kindly coming along for the ride as I found my footing in this new medium, which is podcasting. If you enjoyed this episode, please don't forget to subscribe to the podcast to keep up to date with our monthly episodes. As well, feel free to ping us with any ideas about specific topics or industry guests you would like for us to feature. Thank you. And on behalf of ISS Market Intelligence, I would like to wish you all a very